Welcome everybody to another fantastic episode of the Explain It podcast. We are your hosts. My name is Stephen Hunt.
And I'm Ingryd Hernandez.
And we have such an awesome guest on today. It's one of my favorite topics of all time, which is loans.
Absolutely. Growing up, I was always afraid of being in debt.
Mm-hmm.
And then you go through this mentorship of how you can leverage other people's debt.
Mm-hmm.
And then you realize, wait, that's not a horrible thing. It's actually a tool. It's not good or bad. It's a tool.
Yep.
You know, I went to church on Sunday, and I know that your wife watched
Praise be.
watched the service that we were on, and the pastor said, "Money, is it good or is it evil?" And then waited for the audience to answer, and I was like, "Neither. It's neither. It's love of money that's evil, but it's a tool. At the end of the day, it's a tool. So same goes for loans. Loans are a tool. Now, the goal should be like no to very little consumer debt. But this is not consumer debt. This is backed by an asset.
If it is leveraged debt that is making you money, more money, it's the basics of finance. If it's debt that you have, but you're making more money on that debt than what the debt cost you, then you're winning.
That's right. 100%. So
that basic.
Who here wants to be a debt winner and not a lending loser? You like that?
I like that. That was so good.
Okay, thank you. So with us today is Kirsten VanderJagt, who is an amazing human being. We've actually had the pleasure of having her on the podcast before in the olden days.
Ooh.
Where she talked to us a lot about how she's helping with the affordable housing crisis and how she can actually teach you to be a group home operator. And she has a whole course for that. But this is a woman of many talents.
Oh.
She knows her stuff.
Yeah.
And so her focus today is to help you be a good borrower and to talk a little bit about this brand new to market product called a second loan DSCR loan, which don't technically exist today.
Mm-hmm.
She's going to tell you how you can leverage your home's equity if you're an investor. So this is like one of the most important podcasts you can listen to if you're trying to leverage
I am so
debt.
excited that I get to be a host on this podcast. I have been looking for second position DSCR loans since I started getting into investing, because I saw there was so much value there, but nobody was offering it.
No.
And I searched high and low. And when I say I searched high and low, I searched everywhere. I flipped every single rock that I possibly could, and it just was not coming up. And then Ingryd tells me that she made a great connection, and I'm like, I cannot wait. This is so powerful, and I'm excited for everybody to break this down.
Yeah, so let's bring her up, huh?
Let's do it.
Right on. Hey, Kirsten.
Hello.
Hey, so like we mentioned, we are so excited, especially if you're new to investing or you're looking to grow your rental portfolio. This new loan product that you have is really going to maximize people's portfolios and access to capital. So how about you tell us a little bit about yourself, how long you've been in this space, and we'll get started.
Okay, thank you. And thank you for having me on today. So my name is Kirsten VanderJagt. I have been in real estate and loans for 22 years, and I'm an investor myself. And mostly I've been dealing with lending money for 22 years, either my own or banks. And so when we talk about banks, it could be private money, which would really be a finance lender, or I know, Ingryd, you and I talk about real private money, maybe from your cousin or your friend, versus institutionalized private money, and what the difference is there. And then there's DSCR, and so there's non-QM DSCR loans. Of course, we have our new second mortgage DSCR loan, which is super cool. I just talked to someone earlier today about getting a $400,000 second behind their seller finance first, and that first is $400,000, and so that rate is 4.75 for 20 years they have on that. and then they'll take out $400,000 in second lien position. So that is really going to be amazing for people's post 2020, or if you've just been sitting on stuff, maybe you got a really good deal on a house. And you bought it, with equity in it, and now you're ready to take out a second mortgage, but leave your first mortgage at a really phenomenal rate in place. And so that's a unique product to non-owner occupied, 1 to 4 units per APN number. The reason that I say it like that is because I talk with a lot of real estate investors who will tell me, I have a 12-unit property, and I'll say, how many APN numbers are involved? And they'll go, oh, there's actually 4 APN, because there's maybe like a few units on each APN and they're side by side. And so in real estate investing, I think terminology is interesting. We kind of have to get to the nitty gritty of what's really going on and what the objective is. So anyhow, I'm super excited to be here and talk about whatever it is that you'd like to talk about.
For our newbies out there, what is an APN?
So that's the assessor's parcel number, and some states call them a different terminology, but what you're looking for, a lot of times I know people go on Zillow, which is great in my opinion, because it does give you some really easy to find information. And down at the bottom, it'll give you that assessor's parcel number, maybe not in that terminology, but I think whenever a real estate agent puts something into their local MLS, they are required to put that on there. And so even if you're buying a property that's off market, the likelihood that at one time it was on the MLS and got fed into Zillow, it's probably there. And that would be really helpful for you to actually call your title company. I think, Ingrid, don't you guys own one or something now?
We do.
Technically, yeah. Wow. Hashtag owners.
Yes, for sure. Being part of Owners Club with Pace Morby has now allowed us to own a title company, and they're now operating in 43 states.
Mm-hmm.
So, so we're excited about that journey.
Yeah.
We have a retreat at the end of October in Boston, which hopefully we'll get a little bit more insight as to what that looks like. But really, it's a passive investment, so we have no idea. I don't even think distribution is even a part of the equation at all. So
it's a nice to have.
It's a nice to have for sure.
Definitely a cherry on top if it happens.
Yeah. Yeah.
So having access to a title company like you guys have, and being able to call them and ask for a title rep and very specifically say, can I have something like Title Toolbox or Title Pro 247? They normally have some kind of I would call it a lost leader for real estate agents. And of course, as a real estate investor, a lot of times you're kind of acting in a similar capacity in the way that you might represent yourself. And so you would want to say, hey, can I just get a user ID to whatever this Title Toolbox is, or Title Pro 247? And so what that will allow you to do is go to their website, put in your login information, and then put in the property address and or APN if you can pull it off of Zillow or something, or you can do an owner search if you just want to search by a bunch of owners or something. But it's going to pull up so much valuable data. In fact, if we get into what I think are 7 things that professional real estate investors have in common, and also professional lenders, this is really the first thing that should be done, in my opinion, when you're talking about a property address. Is immediately go pull that from your title login and check it out and see, are they in foreclosure? Are they behind on their taxes? What are the property taxes? Who actually owns the property? And is it commercial or residential? So that way you can see, okay, this is a single family, a PUD, a 2 to 4, or if it says commercial, it's okay, that's not going to be something that I can do a second mortgage on right now.
Yeah. Okay. Very cool. So what I heard you say is, if you want to be a professional investor, so somebody who's going to be taken seriously, somebody who people are going to want to do deals with. Think about credibility packages when you're talking to private money lenders that are not institutionalized. Like, how do you put your best foot forward? And I strongly believe that's one reason, like, entrepreneurs, like, their first hire should probably be an executive assistant, because I do think that having somebody help you get organized and put all of these things in such a way that, like, showcases you as someone who knows their shit, like, definitely. But otherwise, I believe there's some new services that are starting to come around where they can actually help you. Literally, it's like calling one of those people that come to your house and, like, they organize your pantries or organize your garage. Like, make it so you don't go crazy and you can't find the cereal
Get organized
box.
in your business life.
But when it's your business, when it's your entity, like, that literally will unlock millions of dollars, and I'm not exaggerating.
Oh yeah.
It's
incredible.
So it's worth the fee associated, in my opinion, to get your shit together.
Yeah. I totally agree with that.
100%.
I love that. And I'd love to get into those 7 things that you mentioned that top performing investors essentially have in common. But I'd also love to kind of break down, taking it back just a little bit too. You mentioned QM, non-QM. You mentioned a few of those basic things as well, just to give people, if somebody's a brand new investor getting into this, what do those mean? What is a DSCR loan? Is it what we read about in the books where it's an investment loan that you're qualifying for on your own? Like, what is that exactly?
Okay. So first, if we talk about non-QM and QM, so non-QM would be a non-qualified mortgage. And what that means is that usually it has interest only or some kind of component to it that makes it unattractive to sell widely once it has been originated and recorded. So there are less buyers on the servicing is actually different. Servicing alone is just collecting payments, but being the note holder, and so that could be an insurance company, that could be, like, my girlfriend actually owns a note club, and you can just buy notes. And so when you buy them in bulk, you are looking to see if they're A paper, or it could be like B paper, it could be subprime. But essentially, what's the likelihood that either one loan or a bulk buy, let's say there's 10 or 20 loans, and if I have $5 million and I go to, whomever, I say, can I just buy those from you? What did you originate those loans at? And so they might say all of them have a 760 credit score, and they had 12 months reserves, and they're at 50% loan to value. And so, of course, they're like, those are very great loans, at least on the upside if there's a foreclosure. So what we hear there as a note investor or as someone who might want to make loans is, okay, well, if I have to foreclose on them, I'm just going to hopefully get 20% or 30% equity after all the foreclosure fees. But anyway, non-QM is basically saying there's less buyers because there's something that makes them less attractive. And so in the private money world, or in DSCR, which those are actually 2 different things by themselves, and hard money is also something different. So depending on where you are in the country, you and who, like, your school of thought, who you subscribe to, or if you've been in, like me, 22 years working at the lender full time, different types of lenders, they have different ways if they're doing business on the West Coast or the East Coast. And so the people will talk differently. But essentially, DSCR means debt service coverage ratio. And so if that loan is originated using an LLC's name or a corporation's name, then that all by itself is going to be a business purpose loan. That is not going to be a non-QM for like, if your personal name, you could probably go to your normal conventional bank maybe and say, do you guys have a non-QM? So that's like for real estate investors, under my personal name, where I don't, well, you would still put it on your credit report, but you wouldn't qualify using your tax returns. You would qualify using, if the payment on the rental property is $1,000 a month, then the rents would need to be $1,000 a month. And so it's basically not your personal income because you're not giving them tax returns, but you are qualifying off of the debt and the service ratio. In that case, it's 1-to-1. My mortgage payment is $1,000 and my rent on a 1-year lease is $1,000 a month. So I know that my rent will cover that. Now, what's interesting is that normally you have expenses, right? You have to replace a roof once in a while. You have to replace carpet. If it's an Airbnb or a short-term rental and you have tenant turnover, you're probably going to have some type of housekeeper go in there. And so there are operational expenses that sometimes come into play. And so there are some adjusters when it comes to rent and also vacancy rates, because Airbnbs could have a higher vacancy rate. So there are kind of interesting things that happen. But again, talking about that in a non-QM world with your normal bank, they would look at your personal credit report as well, and they would report that on your personal credit because it's in your personal name. Now, if you go to a business purpose lender and they say, listen, we're going to make this loan to you in your LLC or corporation, it's not going to be reported on your personal credit unless you default. And that's great, of course, if you want to go buy a new house or a car and all these things personally, and you're separating out your liability. That's the whole reason that we have an LLC or corporation, and we have a different checking account and different credit cards, is because if you want to file bankruptcy in that LLC or that corporation, they don't come and take your home away from you and your cars, because they're a company has its own social security number, essentially an EIN number. It's its own person. And so in this space, we would basically look at your entity. And so Ingrid, you brought up, like a credibility package. This is really one of the 7 things. When you have an entity, and you can do this today, guys, I would in fact say, please do this today. Get together a folder on your computer for each one of your companies and label it as such. And inside of there, you should really have 5 things all the time. So you should have your articles of organization. So you organized that company under some state, and it's been recorded with the Secretary of State. It has a stamp on it. And so you would get that back probably from your attorney or from LegalZoom or whoever you used. And you have that in your folder that says, I have a company, and it's recorded. Now you have an operating agreement, or they could be like bylaws. Excuse me. So what that is that's not a recorded document. That is something that can change over time. So let's say, like, I have one company that I formed a couple of years ago. We did it 50-50. And last year in December, my partner said, hey, I'm going to do stuff with my kids, and I'm not really going to be involved with this passively or actively. So we had to draft a new operating agreement, because when we formed the company, there were 2 of us 50-50, and that would be in the operating agreement. It would say, these are the managers, or in the case of a corporation, it's going to say something like president, CFO, and secretary, which are different than the directors. So the board of directors is actually something different. But essentially, it's say that these individuals have management control and or they own the company. And essentially, this is like their shares, 20%, 25, et cetera. So for anti-money laundering, which is the 3rd document that you should keep, which you can go on to
FinCEN.
Yeah,
the FinCEN website. And we can share with that in the show notes once we have that put together for you.
That one's so super important. So that's the 3rd document.
You got to get your boy. That's the way I remember it, because it's your BOI. So you have to, if you created an LLC this year, you have 30 days from when you created it to go and get your boy, which I'm trying to remember what the BOI stands for.
Yeah.
But basically, and then if you created it in 2023 or earlier, then you have until the end of this year to report all of that. So we'll put some stuff in the show notes. It's really, really important. Really, really good looking,
Really?
like a Zoolander. Oh, you went to
I went to Trump.
Oh,
Yeah.
I went to Zoolander. I'm older. And you need to get that done. So, Sydney did not get her boy. It's time to get your boy. Ooh, yeah. So
I was just talking with my attorney about that this morning. Same thing, super important. And the other thing I was just going to say is your W-9, super easy to sign a W-9. You can pull that off the IRS website. So those are some of the things. I actually have a 5-minute video. It's on one of my pages, it's basically 5 things each in 1 minute, like what you need to know.
Yeah, let's put a link in the show notes. And what I was thinking of actually putting together is just a checklist.
Mm-hmm.
Like if you have this folder and you have an assistant, or you don't have an assistant, maybe you have a spouse, or if you want to leverage one of the services that help you get organized, you will have here's what you should keep in a folder. Articles of organization, your operating agreement, your letter of good standing. That's the one I always forget.
I always forget that one.
And you should actually
not everybody asks for it though,
No.
either, in my experience with all the loans that I've got.
Really?
It's very dependent on the lender that I go to that asks for that certificate.
Because they're doing it themselves.
Exactly. That's how I also know I like working with a lender or not, is when they stop asking me for things and they go get it themselves. I'm like, I love doing business with you. That's great.
Yeah, make life easier for you. Your W-9, as Kirsten mentioned. I'm trying to think. Oh, your bank statements. So how do you know you're credible? Like you actually got cash flow.
Do you have liquidity for this? Right. And in most cases, when it comes to liquidity, guys, if you have a 401k or if you have HELOCs, if you have a HELOC, you should take all that cash out and just dump it into your bank account. That's the easiest way. Otherwise, most banks that I've dealt with, at least when it comes to retirement accounts, HELOCs, your access to liquidity, maybe not directly in your bank account, they'll record that at 50% of whatever the value is. So if you have $100K in your 401k, they'll look at it as $50,000. Same thing with the HELOC. And
that's what Kirsten taught me too, is 50% of your, very good. You retained it. Very good. So
I love lending. I told you it's my favorite topic. This is great.
You nailed down the 5 things. So basically, letter of good standing, W-9, anti-money laundering, or it's like beneficial owners information, essentially.
Yes, that's what your boy is. Okay.
Yeah.
So, and then articles of organization and your operating agreement. So operating agreement and the boy are pretty much the same, guys. You just have to sign. I promise. None of us who operate this company are going to launder.
Mm-hmm. I mean, I don't even do my own laundry. You think I'm going to money launder? I'm just not into it.
There we go.
This is an entertainment show too. You know what I'm saying?
Ingrid's the only person that has more dad jokes than me.
Yeah, for sure. So, all right. So, Kirsten, your favorite professional investors are the people who have these folders and keep refreshing them. Would you say reviewing them once a quarter is a good enough cadence to keep that ready to go?
Oh yeah, absolutely. And then you guys talked about assets. I think just knowing your liquidity and who your partners are is another thing that makes a investor, more professional, essentially. And so a lot of people will call for money, and it should normally take 15 minutes, maybe 30 to have a conversation. I know Steven and we talked about something and we nailed it down really quickly. Same thing, you and I, Ingrid, we know generally when we jump on a call, we're going to have our taxes in good order, meaning we know I pay such and such, probably a spreadsheet for that property. Here's my taxes, annual insurance, annual HOA. Here's the rents. Is it a long-term rental? Is it a short-term rental? And basically it just takes 15 or 30 minutes. If you're having to take longer than that with somebody, maybe they're letting you like kind of all over the place or something, but usually that's how long a professional investor, they're going to be busy and be like, hey, ask me what you got to ask me. I'll give you, like, I know my numbers, or I have a spreadsheet because I'm organized, and I will tell you, and then you tell me if I can have the money or not.
Well, at the end of the day, it comes down to communication. And so I think we've had this conversation before where if you are representing yourself as a professional and if you can't respond to these requests in a timely manner, it means you're not as professional as you think you are. Like, you really should have either someone assigned to this task for you, or you should already have preemptively organized yourself before you're asking for a lending institution to come and see like what's really going on with your books. So in my opinion, it's really telling of how good you have your businesses running.
Yeah, I think there's a learning curve to some of this though too. I do want to mention, right? If you're constantly going out there and you're doing fix and flips or buying rentals or whatever the case is, I think yes, you should have that all buttoned up. But don't be scared either if this is your first time ever getting a DSCR loan and going through the process and you're not aware of what it's actually going to take, but also get your crap together moving forward after that. Anytime I put anything in for my lenders now, I'm like, oh, it's like easy peasy.
Yeah,
you know what I mean?
Here's the Google Drive link. Tell me what's missing.
The other thing too is that the lenders, in my opinion, as well, should be keeping all of that on file to make it an easier process for the next time that you're doing stuff. Typically, only the liquidity is what needs to be updated, unless you're moving to a different entity. Then you kind of have to start from scratch. But I've also had lenders that never kept anything, and I had to do the whole process from scratch every single time. And I'm like,
okay. And people know that we actually buy creative deals, but in our fix and flip business, there's a reason why we rinse and repeat through the same hard money lender. Let's say we had somebody out there with maybe a half a point better. It's so
streamlined.
Yeah, it's so streamlined.
I don't even call the insurance companies anymore. Like I type in the address and I'm like, this is what we want to buy it for. This is the renovation.
And our hard money lender puts it together.
And they're like, when can you sign?
Yeah.
I'm like, yeah, thank you.
Yeah, thank you. Right. And that also dictates the kind of institution you're working with too, because if they have systems in place that are going to take tasks away from you, and I know Stephen and I have talked about Buy Back Your Time from Dan Martell, great book, that your lending partner should be doing the same too. If you yourself are already organized, you should expect the same from them. Everybody
on your team, right, if they're not specifically hired, should be that type of resource for you, right? Lending shouldn't be a pain in the butt for you, and don't be the person that makes it a pain in the butt for you.
Yeah.
Same thing with agents, same thing with everything. Those people should be assisting you so that you don't have to deal with it.
Yeah.
Right.
Totally.
Yeah. I love Marcus Lemonis. You know, Marcus Lemonis always talks about people and the process and the product. And that's actually one of the 7 things also is an investor who, you know, at least has an idea of first their product, meaning like, what are they after? Is it an Airbnb or is it a long-term rental? And the reason that I bring this up is because if you work backwards that way, let's say you find a pocket of the country that you really like, and you find a hard money lender or a private money lender or a DSCR lender that you really like, right? Like you can figure out kind of you as the investor, like my product is going to be a long-term rental in, you know, I don't know, Arizona, Phoenix, Arizona. That is my product as an investor. And I know that if I do Phoenix, Arizona on a 3-bedroom, 2-bath at this price, I can make this much money every month. So I have a model. That's the product, is the model. And now I need the people. So in Phoenix, Arizona, I need to build out a reliable team, which is like you said, even having a person who could take some of these tasks away from you. You know, I talk about like an elite loan processor or an expert loan processor. And basically that person is different than a transaction coordinator in the private money world. That is somebody who, if you are a quote unquote professional investor or even a loan officer or a mortgage broker, I know a lot of people are signing up to be a broker for a lot of things. You would have somebody like this who basically like puts this paperwork together according to your top 5 favorite money sources. And they take that away from you. So a lot of that is saved and they can, basically update just your entity stuff. And so, so we just talked about the product, we talked about the people, and we're talking about the process. And just, I see that successful investors pick something and pick the area, and then they just get really good at duplicating it.
Totally. I'd say 80% of my portfolio is all through DSCR loans. And that's because I got to the point where I could start to anticipate, okay, what are my LTVs? What specifically is needed? How will this cash flow? What is the debt service coverage ratio on this product right now? How are things moving in the marketplace? It's good to stay informed. And like you said, start repeating that process over and over again, because it becomes way easier to identify those specific opportunities at that point too. Now, with the DSCR loan, love them because I can essentially get unlimited DSCR loans. And correct me if I'm wrong there, but I like it.
You went right. I had that exact question.
Oh yeah.
Awesome.
I'm here for this.
Thank you.
You can get unlimited DSCR loans. Conventionally, you can only qualify for so many loans. Yes, there's workarounds. Yes, you can get portfolio loans. But is that accurate? You can get as many DSCR loans as you want, so long as the asset cash flows and is making at least what the DSCR ratio is, or making more than that.
I would say yes. And it also depends on, so what we're talking about right now is aggregate financing with one lender. And every lender will max generally at 10 loans and then a couple $1 million, depending on how much they want to aggregate to one social security number or entity, so EIN number. And because they don't want to get really heavy with one person and how like all their eggs. So like if that investor passes away, all 10 of those loans or all 2 million of that, now they have to figure that out. And so aggregate, it's like, ooh, I don't know if I want to have this one person have like $5 million and 50 DSCR loans. I'm getting really heavy into this one person. And if something, catastrophic happens, that'll be bad. And so if they sell their loans, then they might have a little bit of wiggle room. So.
Mm-hmm.
And Sydney's asking, how much money do I need for a typical DSCR loan? And I'd like to put a twist on this, Kirsten, because I know one of the things that you're now offering is a second lien DSCR loan. So if maybe we could get that as a question for a typical DSCR and then a question for a second DSCR.
Sure. So a first mortgage DSCR, you're normally going to have to put down 20%. And remember, there's no income documents, guys. So like, that's the whole purpose. No tax returns. The company that I'm with, there's no employment. We just assume you're a real estate investor. Our application is only 3 pages. We hardly ask you anything, in my opinion. And then there's like just some disclosures really. But essentially you're still looking at 20% down. If it is a cash out refinance at 6 months, at least for my stuff, then, just to let you know, you would be able to be at 75 with the cash out. Now, I do something interesting, which is a delayed purchase for recoup of funds within the first 6 months. So if you pay cash for something or hard money and you just like want to recoup it, then you can go at 80. So again, that speaks to purchase and then refinancing either before 6 months or after 6 months. If we're doing a second mortgage, so we don't close those concurrently, meaning that doing it first at, let's say, 80%, and then our second for top tier borrowers is going to go up to 85% combined loan to value. Now, in some people's mind, they might think like, I'll do those together, and then I only have to put down 15% on a purchase, but that's not the case. Not right now. Right now, where we're at is that you would need to already own that property. And then essentially you're just coming, you're saying, can you give me a lump sum of cash out to pay off my other seconds or thirds or whatever I have recorded on title? Or just give me the cash, just a lump sum. And we essentially take your current value And if it's, $1 million is the current value, and 85% CLTV is 850,000, and you owe 400 on the first, then we will look to give you 450,000 all by itself, not touch your first, just do the second, and give you a lump sum of cash. Obviously, we need to clear everything on title to make sure that we're in second lien position. And then we look at the payment between the first and the second to see if you're still cash flowing based on your rents.
And the coverage ratio on that second DSCR is what?
We're at 1.1 and 1.25, depending on your combined loan to value.
Nice.
Can you break down what that means? Because 1-to-1 you mentioned earlier. What does it mean if it's a 1-to-5 then?
So you're making 25% cash flow on the property. So you have to be running $250 a month positive. So instead of it being $1,000 in mortgage, let's go back to that simple example. Your mortgage payment on a first is $1,000. Your rents are $1,000 a month. And now this is also for long-term rental only, you guys, because going into the market with a high-risk product like this, where if we have to foreclose, we really are going to get nothing. Or if they short sell it, we'll be lucky to get $1,000. We have to launch this product basically keeping that in mind. And so with that said, you need to be making money. You need to have cash flow of $100 or $250 to be over the 100 or the 1.0, right? 1.0 is breaking even every month. And we're saying you need to be over by $100 if it's 1.1 or over by $250 if it's 1.25.
That's fantastic. Okay. That makes sense. I mean, this is really for people who have honestly purchased in 2021 or earlier, because you have so much equity that was given to you. Like, here's the positive of the money printing machine we've been in the last few years is that your appreciation probably went up substantially. So you've been debating, oh my gosh, do I go refinance? Because if I refinance, it's such a larger number and I have this really sweet, 2.5, 3% interest rate. I don't want to. And because they don't give HELOCs on investment properties, you've been really limited. You really need to have a deeper network of folks who are willing to lend you that money through a non-institutional private money lending scenario, right? I have those. I have where I bought a property, like my Sedona property. Somebody gave me the $50,000 down payment with a little bit extra cash. I think I borrowed $60K on that one. I don't remember right now. And we used that money for closing costs and to actually put furnishings into the property and whatnot. So once I have enough appreciation there to cover this LTV, the LTV, did we talk about that? What that is on this one?
She said 85% up to for the top tier borrowers.
Thank you. Sorry, I was probably trying to remind everybody that if you're on Instagram, you should be coming to YouTube.
Yeah. Because
we're sharing so much game here, and it's important for you guys to hear, see, and be able to comment better. Anyway, taking my time to that little piece.
You have to.
But anyway, so this is wonderful. But the creme de la creme, especially since the audience that we attract is from our mentorship.
Yep.
Can you get these second DSCR loans on a SubTo purchase? Kirsten, take it away.
All right. So I would love to say yes across the board, but everyone's documentation, when you actually give it to me, is probably going to have some funkiness. Hopefully it doesn't. And what that means is this. We have to be able to get title insurance in second lien position. So you're going to need to have a clean first that's recorded. And assuming that the person who holds the mortgage on the first, that there's not a balloon that they're going to, like if the loan is going to balloon, then that could be problematic. And so if that, let's just say that your LLC recorded the deed, right? Your LLC currently owns that property, then, and it's been recorded because your chain of title, you have to own it to take out debt on it, guys. There's a lot of deed fraud. And we need to be very careful about deed fraud. And so if your title looks good, and if your chain of title looks good, and your ownership looks good, then we're going to need to get the mortgage note on the first, because it's going to tell us how much, it's going to tell us the term, right? It's going to tell us the interest rate. And looking at that, we need to see when it's due. So something doesn't surprise anybody, even you, if you haven't read your own note on that mortgage. And then also we need the mortgage statement, because we need to see what is the current UPB, or unpaid principal balance. And so when you took, or whoever took out that loan, whenever they took out that loan, that's what the balance was then. And those are what the terms were then. Now, here we are some years later, and your mortgage statement might be different. Maybe it was even modified, but that's how we're going to look at that. And we're also going to have to see the current unpaid principal balance. So that way we can give you the money on the second, right? And try and maximize that. But really, we're looking to try and calculate a debt service cash flow ratio. And so my understanding right now, keep in mind that really, like, next week, maybe we should have another conversation if at all possible, because guidelines do get updated regularly in the private money world, especially launching a new product that nobody's doing. And so we're going to go through this on the SubTo stuff, because we understand, like, the golden handcuffs and the desire to keep that first. It's a matter of, does it make sense, you know, on that particular transaction, once we look at the note and the chain of title, that, again, there's no deed fraud involved, and that we can insure that second mortgage, and that you're going to have some longevity on that first mortgage. So there are a couple things we need to look at in the note to make sure that it's a healthy deal.
So what Kirsten just answered is sort of like the Facebook status of, it's complicated.
Right.
But
Yeah, it depends.
but at the end
Everybody's
of the
favorite
day,
answer.
I know, the lawyer answer.
I'm
But
sorry.
no. But here's some fundamental things that I did hear. Dustin Seiler from Utah, our amazing pal out there, is that yes, they will do it on SubTos. It just depends on how well you recorded that SubTo.
Mm-hmm.
So, for example, I bought a property in Houston, and we went through the lawyers, the lawyer, to get that done. So it got title insurance at the time that I closed. So it has all the right elements required for me to be able to do something like this if I wanted to pull equity out, you know, because I think I owe like $210 and the house is worth like $350.
Nice.
Nice. So that would be a potential candidate, because the deed on that property is in my LLC. 1, 2, it was an insured transaction through the attorney's office, right? And 3, hopefully, you know, everything else looks good because insurance has been paid, taxes have been paid, all the potential encumbrances for this property have been pretty clean. So, you know, the cleaner your SubTo deal is, the more likelihood you'll actually qualify for something like this.
This product can be huge in that sense, though, too. And it's something that I'd love to put some numbers to, because I was in a very similar situation like what Ingryd's talking about right now, where I have a SubTo deal, no longer a SubTo deal. I ended up refinancing the whole thing because of the situation. But it's a rental property that I have in Tempe, Arizona. The existing first position was about $300,000. I think it was like $289 by the time we actually did the refinance. But when we took it over, it was about $300,000. The house needed a ton of work to it. But in that situation, the mortgage was only at 2.75%. So my payment was super, super low. So I ended up putting a private money lender on there in second position for $140,000 so that I could gut the whole house. I could get everything going on the house. We had to do the pool. We had to do everything. But in that situation, I was looking for somebody to replace that, because it was cheaper for me to have a 12% interest only private money lender in second position than to refinance the entire thing together. So had I had a product like this probably would have saved me anywhere from $400 to $500 a month, because I would have just been refinancing essentially that second position note that was already existing there.
Oh yeah, isn't this new DSCR. It's amortized over 30 years. So
Crazy.
it's fixed. And then you have to think now, I would presume the interest is higher because it's a much higher risk product. But at that point, you're actually looking at the blended rate.
The blended rate there.
Your blended rate is a little bit higher because it's interest only. So it's the math is a little bit harder. But when you're talking about apples to apples, so two amortized products, the blended rate kind of makes more sense to me.
Oh, and I know even if it was a 9%, you know, DSCR in second, my payment on that would be, let's call it $1,000. It's still cheaper than what the actual private money lender that was charging me, because I was paying them 12%.
And you don't have to worry about that private money lender coming back and saying, can I have my money back? This is an institutional loan. So it's you're getting married for 30 years. Yeah. I love it. Wow.
So good.
So can we talk about when people apply, just so you guys know, you know, I think we're working something out, Ingrid. We're like your special audience and everyone. I mean, when you go through getting a credit report and the application process, it's $199 to pay for like the hard cost of a credit report. And I'm talking about, that's just what we charge if you want to do a loan with my money and my firm's money. And so that will let you get far enough along before you draw loan documents that you see, you know, go through the process. Is it worth it to find out? Nobody's making any money. I mean, we have processors and underwriters that are going to have to look at this and pull a title report and order an appraisal. And whether you order the appraisal or not, I mean, we definitely want to see value come in. We do need an appraisal at some point, but I don't think that it hurts to get these things together and ask for the money, and having a relationship with us the first time, like anything. It's going to be new. We do have some very special staff that's available if you wanted to have them help you, like underwriters, before it even goes to an underwriter. Again, these are elite processors. So I'm just saying, for $199 to pull an actual credit report through the finance lender and kind of, you know, get all these documents looked at, I personally would do it. I have something on seller finance right now. I mean, it's raw land, so I'm not going to be able to do anything because we're talking 1 to 4 units, but certainly I think it would be worth the $199.
Yeah. Okay. So what I heard you say is, if you're curious of whether or not you qualify, there's a service out there that will help you get pre-qualified. There's a slight cost to it, but at the end of the day, it's a lot less than going through the whole hassle of applying for a loan and then getting the bad news that it doesn't. So that's what I heard you say, right, Kirsten?
So actually, that is the legitimate process. If they just want to apply, that's not any kind of outside service. That's just that's doing an actual application and then going.
Okay. Yeah.
Yeah. You know, looking at the docs.
Okay. So Dustin had a good question too. So, and obviously this is a risk, right? Especially if you're going to put a loan in second position. If the loan gets called due on the first, how does that affect your second?
Well, the loan on a first can get called due. I mean, even if you default, right? So even if it's not a SubTo, if you, of course, like seller financing, you have to look at how it was written. But if you don't make a payment, they can just call the whole thing due anyway, regardless of SubTo, right, is basically where you
haven't find yourself in some way your contract with the lender.
Yeah, I mean, the point is that how does it affect us? Well, you're probably going to want to come to us and say, I need a first mortgage because I've got to, I don't want to pay this loan. And so we want to protect our investment in second position. And that would be the real conversation.
There you go. And if you already got that second DSCR, it means that they've already pre-qualified you. You were already considered a professional investor in their eyes. So it sounds to me like you'd probably be in a good position to just refinance at that point.
Totally.
Mm-hmm. Wow. These are great questions, by the way. Keep coming. And then Ryan Seraphin is asking, do I need to currently own a property to qualify for a DSCR? So these are like newer investors.
For my private money, you need to have a 12-month mortgage rating on a residential property. So what that means is that if you have a primary home or a second home or another non-owner occupied residential that you've had in the last 3 years, and you can show me that you have 12 months that you paid on time, then I will do a purchase money DSCR loan with no income documents, no employment. And basically you could do 20% down on that and buy yourself a rental that's hopefully making you a couple $100s a month in passive income.
Hopefully.
And then he followed it up with, can you own or occupy a DSCR loan?
No, you cannot.
Nope. Sorry, Ryan.
Sorry. They are intended to be non-owner occupied for cash flow purposes. I will tell you this though. I have real estate friends who they take people shopping, or like you, if you're going shopping yourself and you intend to one day move into that, maybe it's a good way to get yourself into like a 2 or a 4 unit and let it cash flow for you for a little bit and then refinance out into a conventional owner occupied and then live in one of the units.
Very nice. Let's see here.
Steven's running out of juice on his laptop.
Yeah, I was trying to.
Okay, I was trying to
I
fix.
put Sydney's comment up here.
Okay, cool. Well, he'll do that. I'll stop momming him. I tend to do that. I'm like, oh dear, you need some water. You're coughing. So Sydney said, I wouldn't even qualify for a normal loan right now. I want to apply for this. Can you include a link? Oh, thanks for sending that out, Sydney. Here is. Are you looking? Well, I don't know if you're looking for a first position loan or not, but here is the link that you can use to apply for loans. Oh, there you go. And I just want to go back because I got distracted with Steven's battery going down. So what you said is in order for people to qualify for a DSCR loan, they need to have 12-month history of mortgage payment. And was that mortgage payment any kind of mortgage payment, like owner occupied, or only investment worthy, like investment properties?
It could be owner occupied or second home or another non-owner. So, and it could be a private mortgage as well. That's not on their credit, but they need to show 12 months canceled checks front and back and the mortgage note. So that way we can see that it's paid on time for as agreed.
Perfect. So if like they're using like a service company, like one that we use a lot, I don't know if I want to name them. Sometimes they make me mad, but
they make me mad.
Yeah. But service companies aren't great. I'm just being honest. But yeah, if you're using a service company with one of your SubTo deals, then you can use that as history to qualify for a DSCR loan, which is wonderful. This is great. Great. Okay. And then Dean Saavedra is asking, did I hear correct? That your personal residence can be used to pre-qualify. Yes, we just clarified that. Thank you. See, I got distracted. Dean, you probably got distracted too. And I was like, oh no, his computer's going to go down. So again, if you are interested in applying for one of these loans, please come to oneand2s.com, firstandseconds.com, on the website link right there in the caption, and let us know if you're interested in applying for one of these loans.
Hey, Ingrid.
Yeah.
So really quick, I want to just make sure that everyone is clear in the way that this is for verification of mortgage, not for the actual debt service coverage ratio. So if you're house hacking, if you're house hacking, that would not be the same thing, right? We're just talking about, have you ever paid a mortgage for 12 months on time in the last 3 years? And if that's been on an owner occ or a second or non-owner, then you can come to me and get a purchase or a refinance on another property.
Yeah, Sydney, what I heard you say is that you have a mortgage, you've been paying your mortgage. We just have to figure out, have you been paying on that mortgage for at least a year as a part of qualifying you as a guarantor for these types of loans, or somebody, what do we call them, guarantor? You can make me correct. You can correct me, Kirsten.
A personal guarantor?
Yes.
PG.
A PG. Yeah. Okay. It's a different kind of PG tour.
Yes.
Dun, dun, dun. No,
So good.
No.
It's like the 6th one today.
Sorry.
You can't stop her.
So Sydney, it's just a matter of professionalizing you. Can we consider you a professional investor because you have some of these types of histories, right? Your credit's good, you're making mortgage payments, you're organized, your LLC's in good standing. So if you've purchased a rental and you've had that rental for a while now, like if I had just, okay, that's a good question. Let's say that I have a rental, Kirsten, and I've only owned it for, let's say, 6 months. I have a 1-year lease on it. I do have mortgage history. So I've, owned my houses now for, whatever, 15 years. So I have plenty of good payback on my mortgages as history. Can I go and get a loan on that one, even though I haven't had it for a year?
So you're talking about the seasoning for a standalone second?
Yes.
You can do it for a first. Let me pull the current guidelines on the second. So for seasoning, and remember, guys, this is brand new. You guys are hearing it first here, which is awesome. Great question.
So good.
So what we are looking at, seasoning.
And when guidelines come out for these new products, you guys don't see it. And I know that everyone complains about, I hate doing loans, just period, just FYI. When I have to go get a loan, I hate it. I'm just being real. Just because it takes long. The process is a little arduous. You got all this paperwork you got to submit. It's another task you have to take on along with running your business. So I remember like crippling. Like when I did my very first Morby method out in Phoenix back in 2022, like right when rates were starting to change to the like going negative, right? They were going like from 5s to 6s, and you're an investor and you're like, no. I cried. Oh. It was such an awful experience. By the way, it wasn't with Kirsten, but I cried. It was I hated it. I hated going through that process. But now looking back at how I could have helped myself using the fundamentals that Kirsten just went over, like have your folder ready with all of these typical documents you're requested, along with updated bank statements, any retirement fund statements you might have, any like a list of all your assets. Like I could have helped myself so much more if I had all of that organized and sent over. And then I could still just have gotten mad over the whole appraisal issue that I had. But that's a story for another day. But it would have been less painful. It would definitely have been less painful.
So to answer your question, we're at 6 months ownership on the subject. And also, I know we only have a few minutes left, but I do want to say, like, I think that there's a service coming to look at this entity kind of stuff and get that stuff ready for people who hate doing it. It's legal stuff, guys. Like, we're dealing with legal stuff and money stuff. And if you are a creative type or you like to talk and be like out doing stuff, please just pay the couple bucks for somebody to put together your entity documents and like go through that. They look pretty good. Also, I know that my elite processors will like package your entire thing except for your appraisal. I don't know, for a couple $100, but I don't want to like plug them. I'm just saying, if you hate doing that stuff, it does not have to be painful. You really need to bring in somebody who will take it and make your life easier.
Well, like we read on Buy Back Your Time, like there's legitimate people who enjoy doing that. Like they literally
you're doing them a disservice by not letting them do it for you.
Yeah.
Like, it's true.
Yeah, like those people we were talking about, people who like organize your garage and your pantry and your closets, and like
they get something from that.
Yeah, they like it.
It's weird.
Yeah.
I don't mean,
I love it.
It's like
a mess. It's organizing in a different way. You guys touched on it. Also, I just want to say, like, professional investors, they get this stuff ready in advance, like 30 days in advance. And they do go through this process because when the time comes, they are like ready and on it. And you want to get a legitimate proof of funds letter. You know, people also fraudulently put those together where they're saying, oh yeah, I've got money, right? Like you can buy one in private money online and they'll just send you a proof of funds letter. And then what happens when you can't execute that sale? We don't want to do that here. We want to like look at it and go, okay, you can feel confident that you can get a non-owner occupied property or even a renovation, right? A rent ready, a renovation, ground up construction, like second mortgage. Let's really work together.
Yeah, for
Love that.
sure. Okay, David had go ahead.
I was going to actually bring up David's comment there too. So David Lynn says, is it a personal guarantor as a separate person to be the lendee's guarantor, or is it a personal guarantee such that the lendee personally guarantees the loan? From my experience, it's always the person getting the loan. So me, if I'm going to get a loan, I'm the one putting a PG or a personal guarantee on that. However, I've also had it work out to where they can use anybody within my entity as the personal guarantee or guarantor. So if my credit gets shot, which actually happened to me for like a certain period of time, Amex came after me and it was the most awful thing ever. And they hurt me and I'm not over it. It was so awful.
It's okay.
I didn't do anything wrong. Anyway, they came at me and it dropped my credit score. So for me to get the top rates, I had to use my wife or I had to use Ingryd. So we were able to use them as a personal guarantor instead of me. I just wasn't the one signing for the docs then at that point.
Same thing with us. We would do that. You need to have 20% ownership. And I'm not telling you to set up your operating agreement that way, but people slide on and off of operating agreements and in and out of LLCs and corporations for various reasons. You need to talk with your legal and CPA. But the point is that, yeah, it's a very creative world. And in the DSCR space, if you have somebody with 20% ownership, at least with my money, and they're going to personally guarantee it, we would take their credit score.
And again, this podcast is for entertainment. And
Yes.
if you're going to change ownership like that, don't forget your boy.
Don't forget
Your boy is going to be important to report if anything like that changes. Very cool. Well, this was both entertaining and educational.
I love it.
Yeah.
I could talk about this for another hour.
But he's got to go pick up his kids, so we're not going to do that. But anywho. Well, Kirsten, you have been an amazing, amazing guest for us. We hope to have you back so that we could get more information, especially as this gets in the market and people start leveraging it, so that they understand how they can leverage.
Totally.
Yeah.
Totally. And I'm sure you can get a little bit more strategic too as time goes on to be able to take a lower LTV on the front end for a first position loan through you, right? And then you can eventually get a second, maybe get a better combined rate. I'm sure there's going to be so much strategy that will come into play with everything that you guys are working on right now.
Yes, absolutely. And just so you know, on that entity review, that 5-minute video, I did drop that link in the private chat if you want to post it. And I'm just really grateful for your guys' time and for everyone who's listening, and, you know, look forward to becoming friends and moving money and making you guys money.
Oh, I love it. Thank you. All right, guys. Well, again, if you are interested in one of these loans, specifically the second loan or any loan that Kirsten has available, please go to firstandseconds.com, spelled one and hold on, I can't do it while I'm talking, 1and2s.com. And then with that, shall we wrap it up, Stephen?
Let's wrap it up. Thank you all so much for joining us. Let us know in the comments what else you would like to see and have us talk about, any guests you'd like for us to bring on onto the Explain It podcast. But without further ado,
right on. We'll see you guys. Yeah. See you next week.